So is this just waiting for a DC package to get passed? Is it that easy? Is that our catalyst to find the bottom, or is it going to be a trap for bulls?
So thanks for having me. I think the catalyst from the fiscal side is absolutely needed because clearly the monetary side, both are going to be historic, Oliver. We've been talking about it now for, 3 weeks since that initial 12% drop back in February, which was, how we phrased it as a whoosh. And then, it's gotten worse as the data's come in. But even back then, you knew that you were going to have historic monetary and fiscal stimulus to fix this, or at least stabilize it. So clearly, it is stunning to me and the market that at this time there's any politics being played, but that's where we sit. But ultimately, Oliver, as I've been suggesting on the network, we're in the bottoming process that is human nature based. This, in our opinion, is not based on any kind of fundamental view. The idea that anybody, no matter what kind of team of economists and PhDs you have, there is no way without the data that you can come up with a rational fundamental view of the market, which leaves you back to the human nature side of the equation, which is the path that we have adopted over the last few weeks.
If it's human nature, then, Tony, what's more important, fiscal package getting passed or coronavirus count slowing down? Because I would think human nature, it's a little bit of both, but maybe even on the side of the virus, to where if we do get help, but the fear and panic is being driven by coronavirus, then maybe it's that is being the main catalyst.
So I think that is absolutely the catalyst for the decline, but I think the panic isn't necessarily the coronavirus. I think the panic in the market and in people is the fact that they're not working and that their small business is failing and that the government is standing there trying to figure out, the nuances of it instead of just coming in to help resolve some of the small business and corporate issues that are out there. That's the panic, is that you're being forced to sit at home while your business and your melts. So I think you really need a way for the public to feel like they're not going to get laid off and everybody's going to be out of work. And then you can handle the health side of it, which is going to be to stay home.
Tony, right now I'm looking at a chart from your latest report on correlations. Obviously, they went very, very high, close to 1 during this panic-driven sell-off. As we start to see this break apart, should investors be encouraged even on down days when you have winners in a market? And as Nicole described, and what many other investors have started to say, is nibbling or trying to maybe buy up some of the most beaten up names. Is that an important first step?
Well, I think what typically happens is people, when the market's going down, they're nibbling. And when it turns, they're like buying it hand over fist. When you get these kind of panic declines in these human nature playbooks, when you get these panic declines, Oliver, they don't nibble their way up. You get monster rallies off of the initial panic low, and unfortunately, those rallies typically fade, and you go back and test the low. But those rallies can be sharp. You as you saw in 2011 and 1987, you had very quick. You recoup 30 to 40% of the drop from peak, and ultimately, like I said, you give it back, but it happens pretty quickly.
Tony, right now, what's the direction of most pain? A lot of traders around here like to say that the market will go against as many people as possible. Is that pain trade higher right now? Do you ascribe to the belief that we could have a serious rip to the upside?
I think you can have a serious rip to the upside, but the pain trade is still lower. People are the three phases, and I think it's really important that people like me remember, that people are losing money. It's not a trading game. This is real people's livelihoods and retirement, and that's why we're trying to guide versus say do this or do that. But anyway, the bottom line is typically what happens is you get that panic move. And that relief, that pain trade is still down, but everybody gets forced out through forced liquidations. Like we heard some of that over the last week. We're
not there yet, you don't think?
Can you hear me?
We're not there yet, you don't think, Tony? Because I'm looking at Bank of America fund manager surveys, Goldman fund manager surveys. They say they all raised the most level of cash in history. So the pain trade, though, is still in equities, even if they're all out?
Well, you just know the pain trade right now is feeling like, yes, there has been a washout. There has been forced liquidation. but I think it's a relief rally. The bottoming process is you go through a panic, and then you get into a relief rally. I think if you go up, even if you got out, you're going to feel like the economy and the markets will be okay. We just want things to be okay at this point. It's not how to make money when you're in this kind of decline, both economic and market-based. It's just you want to make sure that the system is still carrying forward. So even if people did liquidate and they got out, at least going up, you feel like the system's going to be okay. So I think I would step back from the idea of a pain trade and go maybe toward consensus. The consensus is clearly that you're in this economic and EPS decline that's going to be very hard to come back from, absent especially any kind of fiscal stimulus.
Tony, last time you were here, you described the playbook coming out of this as being post-recessionary, that you're going to want to own the stuff that bounces back out of an economic decline. Is that still the case? And give us the update. What looks good to you? Is it banks?
Oliver, the playbook it should not change. You know, we have, it's again based on, you've had this economic decline, but we're still literally in the panic phase of the decline. So we're not ready to step in yet. I know people are nibbling and people are saying, okay, it's a great long-term value. The only time that the only way to know that you've made that initial panic low is through a multi-week rally, like a 2 to 3 week bounce back where, like I said, you get 30 to 40% of what you lost. That's when you know that you probably made that initial panic low, but you go back and retest it. That's where you want to employ the quote-unquote post-recession trade, which would be, frankly, anything cyclical. This is a historic decline in economic activity. So you are going to get, the way we've phrased it is once you get through this bottoming process that we've talked about, which is, like I said, you may be near, quote-unquote, the low, but you're not going to know it until you test it maybe 4 to 6 weeks from now. So at that point, that's when you want to look to be buying offense or cyclical. So we took offense off the field on January 20th when we downgraded the market. We're looking, as I've said since that day, we're looking to put it back on the test of wherever the panic or whoosh low is.
Tony, I'll play a little devil's advocate here. Since the records we broke on the way down were in speed, not magnitude, what makes you think the playbook will look like the past in terms of retesting lows and kind of grinding your way out to a bottom? Because if the estimates right now I'm looking at are 20, 30% GDP declines, as much as 30 to 50% unemployment. And I mean, I'm pulling figures here from big sell-side banks and Fed presidents. That seems like a bar that's so extreme that if we beat it, then maybe we don't have to retest. Maybe this thing does move as fast to the upside as it moved lower. Is the bar here just so extreme that we're going to get another extreme move in one direction or the other?
I do believe, like I said, you will get that kind of sharp move off the low. People will think, are likely to think that it'll be a V bottom, but similar to the crash in 1987. I was there. I sat there. I watched strategists. It's what made me want to become a strategist. I watched how they react, right? And what happened was you got this vicious oversold rally. Vicious. The market went down 33%. It had one day of down more than 20%. And it had an incredible bounce back. And everybody thought, okay, maybe it's over. And in December, that was in October, then in December, early December, you tested that low. It was the same thing in 2011 when you got that 18%. Oh my God, what was that in under 2 week decline? And then again, it felt like it was over when you bounced and recouped 40% of what you lost. Guess what? It tested the low. So I hope we go straight up. But I think human nature, which is what's driving this right now, is very consistent.
Tony, are you impressed with tech? Last question real quickly. Tech semis seem to be pretty stable in today's market. A lot of folks thought they were going to lead us on the way down. They basically just moved with the S&P 500. Does that mean they're going to lead us on the way back up?
They should. That's that cyclical play. Oliver, you really highlighted an important point. There's no time in the history that I can see where the correlation of the individual S&P 500 components to the index was as high as it is right now. The only two times that came close were at the ones I keep mentioning, 1987 and 2011. So everything's going to go back up. But coming out of when we do finally make the test low, it'll be the more levered and the more beta and the more cyclical will do the best.